Hi, I'm Valerie Leonard, founder of EverThrive Financial Group. And given all the volatility that we saw in the market last week, I wanted to record a quick video to help explain what's going on. So this video is going to be fast. I want you to stick with me as we talk about whether this bumpy ride is going to continue. Now, every investor is a little bit different, and I want to talk a little bit about more moderate or balanced investors first, and I'll explain why here in just a minute. But we know that many investors aren't willing to take a significant amount of risk. And traditional risk management strategies teach us that one of the best ways that investors can manage their risk is by developing a more moderate or what we call a balanced portfolio. Now, in this case, there's no guarantee of a profit. Historically, this type of portfolio has fared quite well, and it can help take the sting out of the ups and downs of the markets. And the reason for this is that a balanced portfolio will typically invest 60% of the money toward a diversified basket of stocks, and then the other 40% to a diversified basket of bonds. So the thought is that if the stocks go down, the bonds will go up, and then vice versa. And while this strategy has worked really well over the long run, it hasn't worked well so far in 2022. So to give you an example, many balanced funds are down well over 10% since the beginning of the year. So what's happening, and why am I talking so much about balanced investors right now? Well, to understand what's causing this, you've got to first understand how the basics of the bond market works. So I'm going to make this really simple for you. If you've ever bought a home, you've likely borrowed money from the bank. And the bank lends you the money for a stated period of time, let's say 30 years, and then you pay the bank interest every single month in exchange for the loan that they make to you. Now, that's how they're going to make money off of that interest payment. Well, when you buy a bond, you're kind of doing the opposite. You're actually lending your own money to a company or to a government, for instance, and as long as they borrow the money from you, they have to pay you interest. And when the bond matures, they're going to repay your principal to you in full on that maturity date. So the loan could be short-term in nature, so let's say maybe less than 3 years, or it could be long-term, up to 30 years. And the rate of interest that they pay you depends on the environment at the time that you agree to lend the money to them. And if you want, you do have the option to sell your bond to a third party before the loan matures for whatever they're willing to pay you. So you can kind of cash out at that point. And they're going to start receiving the interest that you would have originally received when they buy that bond from you. And you're going to receive a lump sum payment for the value of your bond. Okay, so that's a quick lesson on bonds. You also need to know that the bond market is typically where more conservative investors choose to allocate their money because historically, it's typically been less volatile than the stock market, and it pays those nice interest payments consistently. So the trouble is that last Friday, May 6th, the aggregate bond index was down 9.77% since the beginning of this year. That is a huge loss, and it's extremely rare to see this happen. So what is driving the bond market lower? Well, you got to understand that not all bonds are created equal, and they all react a bit differently when interest rates rise. So take this fishing pole here. Way down yonder on the tip of that pole, you've got your 30-year bonds. And when I go to cast my line, the rod has a great distance to travel, but the handle of my rod only moves a small distance compared to the tip of the rod when I go to cast it. So the handle is more like a short-term bond with a maturity date of maybe, say, less than 3 years. And the trouble today is that the Federal Reserve has been raising interest rates, which drives the values of bonds down. Okay, so interest rates and bond prices tend to work opposite each other, sort of like a seesaw. So if interest rates go up, those longer-term bonds on the tip of the fishing pole tend to go down further than the shorter term bonds do. Now, let's put these losses into perspective. This chart shows the Treasury bond market going back the past 20 years. So you can see here on the far right hand of the screen how much bonds have fallen since they peaked in August of 2020. That is quite a move. And the trouble is that the bond market needs to stabilize in order for the stock market to do the same. So investors are not only getting hit with a negative stock market, but they're also getting hit with a negative bond market at the same time. And this is really rare. So if you think back to that 60-40 allocation for a more balanced investor, both their 60% of their bond portfolio is going down, and then the 40% of their stock portfolio is likely going down as well, which is leading investors to sell out pretty rapidly. So while we're at it, let's take a look at the stock market. This also goes back 20 years. And while you can see that the market has turned lower since January, it's not technically broken its uptrend like the bond market has. So it's sitting at a critical level. We're watching to see if it will hold up here. As investors, we must have a plan if this market goes lower, and we must have a plan if this market goes higher. So for those of you that have chosen to partner with our team, please know that we're ready to take action regardless of which direction this market goes. If you're a 401k investor, you can reach out to us and we can help you navigate your 401k account. But that doesn't mean you're going to not lose money. It just means that we can work together to manage your money in a way that helps hopefully position you for what may be ahead. So what actions should you yourself be considering at this very moment? So the best advice that I can give any investor at this point in time is to evaluate your risk tolerance. If you're nervous about losing money, this is a great time to take a risk assessment to determine whether your investment should be repositioned to take risk off the table. If this is something that you'd like to do, you can click the link below where you'll be redirected to an online risk assessment to pinpoint how much risk you want to take, how much risk you need to take, how much risk is currently within your investment portfolio, and we can also help you determine how much risk you should take going forward and how your portfolio should be positioned. And one more thing, I've been managing money on behalf of clients for the better part of 2 decades. And in my experience, investors tend to let their emotions get in the way of making prudent investment decisions more often than not. And in my experience, investors tend to buy high and sell low, as you can see here, and that's the opposite of what you want to do. So when markets are moving higher, they start out encouraged and confident, and they experience the thrill of making money. And when the market peaks, it's almost as if there's an irrational euphoria, and they experience surprise when markets start to turn negative. And then their surprise can quickly turn into nervousness and then worry. And then when they start to panic, that they typically sell right around the time that the market tends to bottom. So our team at EverThrive Financial wants to help you avoid such decisions. So call us if you would like to talk further about the next steps for your money. We offer professional money management, fiduciary guidance, risk management, financial planning, life, disability, and long-term care insurance, and much more. So we'll look forward to hearing from you. I'll keep you updated as conditions change. And if you have any questions, don't hesitate to reach out.